What? SCHD has returned just 7% per year over the last 3 years, while tech stocks have soared over 12%. Is SCHD falling behind, or will the 2025 Reconstitution turn things around? That's the question I always get.
So if you own SCHD, then pay attention because something big is coming. So I got a phone call from a client of mine asking me if he should stay invested in SCHD or just swapping it for another ETF. So in this video I will give you my honest answer to this client and I break down 3 levels why you want to hold SCHD for the upcoming Reconstitution. Now, if you haven't heard about this yet, that probably means you have wisely followed my advice to avoid checking the stock market every 5 minutes. And that's a good job. But seriously, here is the thing. In March 2025, SCHD is shaking things up with a new 2.4% minimum yield rule, and it could seriously impact your portfolio. Some analysts are even throwing out bold predictions of a 14% return. Later, more on this. But is this prediction true, and is it smart to stay invested, or should you rethink your strategy? So now let's talk about level 1. Why SCHD provides stability even if markets get rough. If you've been watching your SCHD returns lately, you might be feeling a little bit disappointed with what you are seeing on your brokerage statements. So let's be honest for a moment. For years, SCHD was the golden child of dividend investing, delivering impressive 11% annual returns over the past decade. That performance made it a cornerstone in countless dividend portfolios, with investors praising its reliable income stream and solid growth. But in the last 3 years, SCHD returns have taken a nosedive, dropping to a disappointing 7% annually. That's less than half of what long-time holders had expected. The question I get asked a lot is why? And the answer becomes clear when you look at what's been driving the broader market. Technology. And the market has become increasingly tech heavy with the Magnificent Seven like Apple, Microsoft, Apple, etc., powering much of the gains we have seen. And here's the problem. SCHD doesn't hold a single one of these market leaders. Not one. Instead, when you look under the hood, you will find companies like AbbVie, Coca-Cola and Home Depot as SCHD top holdings. And don't forget this, while these are great companies with long dividend histories, they simply haven't been able to match the explosive growth we have seen in tech. And in case you can't remember, in 2001 the dot-com bubble burst, leading to a massive stock market crash. Many investors who went all in on tech stocks lost huge amounts of money, wiping out billions of dollars in wealth. So what's the lesson here? Diversify. No matter how strong a sector looks, betting everything on one sector is a risk you don't want to take. And no, I'm not saying history will repeat itself, but I'm saying you don't want to be too focused on just one sector. So when you look at it from this perspective, it's not underperformance or a mistake. SCHD is built for stability, not speculation. It follows strict rules such as 10 plus years of dividend history, so no young, fast-growing stocks, strong cash flow and low debt. They only look for stable companies. Market cap over 500 million. SCHD follow strong free cash flow to debt ratios. These quality filters are designed to include only the most financially stable companies. And that's exactly what you want as an investor, right? So I told my client the other day that in the past, these quality metrics were SCHD's superpower. During market downturns, they protected investors by keeping the portfolio filled with companies that could weather economic storms. But more importantly, when the market crashed, clients of mine could sleep at night knowing that these companies had the financial strength to maintain their dividends. And that's also really important, right? And what works as armor during market declines has become a little anchor in the current environment. And that's totally okay, because that's where level 2 comes into place. SCHD Reconstitution could make your portfolio stronger? Many investors are asking this question right now. So when you are asking yourself this question, then remember this one important thing. Don't chase returns. Smart investing isn't just about chasing yesterday's winners. Think about your personal game plan and stick to the course. That's the most important advice I can give you. So if you are still thinking about dumping SCHD, then give me the next couple of minutes, because you don't want to miss this, because there is something massive brewing behind the scenes that could change everything. In March 21 in 2025, SCHD undergoes its most significant transformation in years. So what's the biggest change here? The minimum dividend yield requirement for companies to stay in SCHD is jumping up to 2.4%. And this might sound like a small adjustment, but the implications are big. This single rule change is about to kick out some important names out of your dividend portfolio. Home Depot, for example, the number 10 holding in SCHD, doesn't make the cut under the new rules. Neither does BlackRock, the investment giant that's currently the number 9 holding, and these aren't small players, right? But it doesn't stop there. Bristol Myers, Pfizer and UPS are also likely heading for the exit. So think about this for a second. These are companies that dividend investors have relied on for consistent income for years, and they're about to disappear from one of the most popular dividend ETFs on the market. But every exit creates an entrance opportunity for someone else, right? And therefore, higher yielding companies are warming up, ready to take their place. We are talking about dividend powerhouses like Procter & Gamble, Devon Energy, and even ExxonMobil could possibly join. But first, if you enjoy videos like this and want to discover smarter and faster ways to build your wealth, even if you are not there yet, be sure to subscribe to my channel and stay up to date. The current SCHD yield sits around 3.5%, but analysts are projecting this could jump up to over 4% after the Reconstitution. That's a massive upgrade for income-focused investors who depends on those quarterly dividend checks. But the real story here isn't just about higher income. It's about total return potential, right? Your long-term game plan. So while SCHD has been delivering those modest 7% returns recently, analyst forecasts on tip ranks are pointing to something much more exciting. With a price target of $31.5 by the end of 2025 and the dividend payout, we are looking at potential 14% total returns. And that's massive, right? Then we go into level number 3. SCHD will benefit from a stock market crash. And yes, the reality is no one can predict the stock market. So the question here is, can SCHD really pull off this transformation? So all the evidence points to yes, and I will tell you why. The market doesn't stay in one place forever. The tech-dominated rally we have seen in recent years could be giving way to something different. Because in 2023, the S&P 500 did a 24% return. And in 2024, it did a whopping 23%. So when the market would take a turn from high-flying growth stocks towards value stocks, SCHD could be in a great position. So yes, it's easy to feel frustrated when you compare SCHD to the tech sector, which is doing really well. But before you start second-guessing your investments, ask yourself this: why did I buy SCHD in the first place? If you are like me and a lot of our clients, you didn't buy SCHD to chase short-term gains, right? You probably bought it because it's a safe haven in times of market uncertainty. Because let's be honest, market crashes aren't a question of if they happen, but more likely when, right?
And this last 50% decline, one of I think 4 I've experienced, was they're all different. That's one really important thing. Don't say I've seen all this before. You never, very few times has the same thing happened twice, and in the financial markets, the same problems happen twice. Yeah, each one is its own. There's some statement like, all happy families are alike, and all unhappy families are different, but all unhappy families are alike in their own way, or something like that. And the problem here is that all these bear markets are very, very different, inspired by different things, sometimes mathematics, sometimes investors' emotions, and sometimes by external factors.
SCHD is built for stability and cash flow, making it a powerhouse during uncertain times. And long-term wealth isn't built on hype. It's built on smart diversification to build your wealth smarter and faster, right? And that's exactly why I stick to my 3 ETF portfolio strategy for sustainable long-term growth, which you can see in this video. Now, before you decide to hold or sell, I want to hear your strategy. Are you doubling down on SCHD or rethinking your approach? See you in the next video.